Hello, everybody. Lars Christensen here from my kitchen. Monday, the 2nd of March 2002. I'll do this small little video to give my comments on what's going on in the global financial markets in regard to the coronavirus, or what we in economic terms call the corona shock. I really had felt we had entered a period of a fairly new great moderation. If we look at the U.S. economy over the past decade, essentially since the early 2010 or something like that, U.S. growth has been extremely stable. Nominal GDP growth basically on a 4% straight line since then. And, of course, we've had ups and downs. We've had a euro crisis in between. We've had lots of political uncertainty. We've had Brexit. We had Donald Trump. We have trade wars and all of that. But if you look at the markets and we look at US GDP numbers and US macroeconomic numbers in general, we've had extreme high level of economic and financial stability. It might not have felt like that, but if you look at the numbers, it's actually like that. And my view had been until now that we essentially now was in an operational framework where the Federal Reserve have been able to more or less manage nominal demand in the US economy in such a way that we had returned to some kind of great moderation, and where most shocks, for example, political shocks, the trade wars and so on, essentially just was what we call relative shocks, or shocks that might have changed relative prices, might have hit some sectors of the economy, but the overall macroeconomic framework has been rather stable. I believe that should be the case until last week. Obviously, I have been worried about what have been going on with the coronavirus in China, but I have had a hard time getting my head around the economic impact of it. I think, as most investors also have had, and most macroeconomists and commentators, essentially from the perspective of, this is rather genuine uncertainty. We don't know how this would unfold. And I, in my comments on the coronavirus, I have been very eager not to say anything in regard to the actual virus and how that could develop and what the impact of the virus in itself is. I don't know that. I'm not a trained medical doctor. I have no expertise in that. I would listen to expertise on that, but that's really not my point here, and that's not the point I want to make here. The point is, first of all, I want to understand how this affects the global economy, and secondly, I want to understand how central banks are likely to act and how they should act, if they should act, to the shock. So let me focus on that. I've written a couple of blog posts over the last week on marketmonetarist.com on this issue, and I don't want to go into all of that. This is more like a status right now on where we are and what's to be expected next. First of all, if you look at the corona shock from an economic textbook perspective, this is a classic textbook supply shock. There is disruption to the supply in the global economy. How does that manifest itself? Well, in the case of China, what we're seeing is the closing of large areas, millions of people in quarantine, cities being closed down. Essentially, from a production perspective, you close down production. That's the supply side of the economy. The other side of this is, of course, that you don't have the supplies from Chinese subcontractors coming to production, for example, in China or in Europe or in the US or North or other places in Asia. So that's another kind of supply shock. And then, of course, we have seen the spreading of the virus to Europe, to the US, to Australia, to New Zealand, for example, is spreading around the world, and we're seeing similar supply shock effects there. So these are well-known supply shocks. And by any measure, these seem to be very, very large-scale supply shocks, at least in the case of China, and we can see that from the pure macroeconomic numbers. Over the weekend, we got PMI numbers out, and there is a collapse in Chinese production, which is essentially is on a scale that might be bigger than what we saw in 2008. So a very, very substantial negative supply shock. So in terms of central bank action, if you read the textbook, you would say, well, it's a supply shock. Central banks shouldn't react to supply shocks, and therefore central banks should do nothing. I've seen a lot of these comments over the last week. Central banks shouldn't do nothing. And I agree. Central banks should not try to stimulate demand in the economy in the response to supply shocks. That's a general view, and I fully agree with that. But there are two issues that is important to understand here. First of all, the supply shock is one thing, but another thing is how will this affect the way central banks conduct monetary policy, or how will it play together with the way central banks conduct monetary policy? Take a central bank like the ECB or the Federal Reserve. Both of these central banks essentially conduct monetary policy by controlling money market rates, the short end of the money market curve in some way. The policy rates essentially is that they're trying to control money market rates. They do that by expanding or decreasing the money base, intervening in the money market in some way or another. You could say that they are essentially trying to shadow what we call the natural rate. Where would interest rates be in an economy where the central bank did not intervene? Where there was no central bank and there was no money, where would interest rates be? Let's imagine a world without money and without a central bank, a barter economy. In a barter economy where there is a negative supply shock, you would expect the natural rate to decline because trend growth in the economy goes up, savings goes up, hoarding goes up. So that pushes down the natural interest rate. If you have a central bank which is conducting monetary by controlling the money market rate, it's essentially trying to shadow that natural rate. So it's a negative supply shock that pushes down the natural interest rate. The central bank should move its key policy rate down to reflect that. That's not monetary easing. That is just a central bank avoiding to tighten monetary conditions. So that's the first thing. Doing nothing in terms of not changing monetary conditions in the face of a major negative supply shock would imply cutting interest rates, policy rates, to reflect the drop in natural interest rate. So that's the first thing. Second thing is that to the extent that this have an impact on the demand for safe assets and for cash, and we've seen that, buying treasury bonds in Europe and in the US, we're seeing a hoarding of money, we have seen some dollar strengthening, we see all indicating that there is increased demand for safe assets. That's essentially a negative shock to money velocity. Then it becomes monetary, then it becomes a demand shock as well. A central bank that is doing quote unquote nothing should offset this negative velocity shock to keep monetary conditions unchanged relative to what target the central bank has. So by doing nothing, meaning not changing monetary conditions relative to the monetary conditions you need to have to hit your, for example, your inflation target, would imply cutting rates, providing liquidity, etc., etc. That is doing nothing. If central banks, on the other hand, say we refuse to expand the money base, we refuse to cut rates, it would not be doing nothing. It would implicitly tighten monetary conditions. And this is my point. And what we saw during last week, in my view, was markets not only reacting to the news on the coronavirus, but also to the worries that central banks might not cut rates to reflect the drop in the natural interest rates and might not offset the shock to money velocity. Hence, the markets were reacting to expected tighter monetary conditions. And if you listen to some of the comments made last week from central bankers, for example, Bundesbank chief Jens Weidmann, who said, we shouldn't do anything, meaning we should effectively tighten monetary conditions. Or Bollard coming out from the Fed saying essentially the same thing. Well, it's too early, we don't need to do anything on Friday. So we're telling the markets, we favor tightening monetary conditions. That would not imply hiking interest rates, but effectively it would be tightening of monetary conditions because natural interest rates were going down, the demand for money was going up. You need to offset that if you want to keep monetary conditions unchanged. So that was where we were all last week. But then Friday night, finally, and I must say I had expected something like this. I put out my own blog post on what statement I think the Federal Reserve ought to put out. It was somewhat more radical than I expected any central bank to do. But I encourage you to read it. Maybe you will see the difference between that and what they're actually saying as some variation of central banks not doing enough, or maybe doing too much. I don't know. But then Friday night, after I wrote my statement, unrelated, I should say, Federal Reserve Chief Jerome Powell came out with a statement assuring markets that the Federal Reserve had noticed something has gone on and essentially would move. It was quite vaguely formulated. It was quite short statement, but nonetheless, it was a statement saying that the Fed would act, indicating that will come a cut. The market at that time already priced in rate cuts, but after the statement, priced in further rate cuts. The Goldman Sachs during the weekend has concluded that it's likely that the Federal Reserve would cut by 50 basis points, even before the upcoming FOMC meeting in 2 weeks. I think that is very likely, and I think one of the reasons that the equity markets, for example, today is reacting positively is the expectation that the Fed will get ahead of its curve soon. Another thing that I have been hinting in my commentary is that I expected coordinated action, and I think we got that now in the sense that today, this morning, both the Bank of Japan and the Bank of England, two other major central banks in the world, have come out, make statements echoing what the Fed said, but also said other things. Two things I note. First of all, the Bank of Japan said would potentially do asset purchasing, meaning stepping up quantitative easing. I think that is the right thing to do in a situation where we see a rise in the demand for safe assets, increase in money demand. You need to respond to that by providing more liquidity, by increasing the money base to counteract, offset the rise in money demand. We are also operating at the zero lower bound, so central banks need to take that into account, meaning it's very important to signal that the central banks mean this and mean business and want to go along with that. Potentially, as some commentators are saying, doing this in coordination with the finance ministries around the world. We are quite away from that, but that would help in the sense of indicating that we mean business and we will not allow deflationary expectations to develop. Secondly, the Bank of England is out also saying that more or less the same thing, but also indicating that it's talking to other central banks in the world, hinting that this is part of coordinated action, which I think also indicates that central banks are signaling that they mean business. Later this week, as I hear it, we have G7 central banks having a conference call on this. I'm pretty sure that they are already communicating unofficially. So central banks are getting back in the game, and I think that essentially is very positive. However, I have two worries. First of all, we have already priced in around 100 basis points cut from the Federal Reserve over the coming year, more than 50 basis points cut over the next couple of months. If the Fed fails to deliver on the second part of this, the latter part of this, then it will signal that it is hesitant to act immediately. And cutting less than market pricing effectively is monetary tightening. We haven't heard anything from the ECB, not surprisingly. The ECB is foot dragging and haven't understood anything yet. So we need probably the Federal Reserve to lead this. So the other thing that worries me is, of course, that this now surely is a negative demand shock. If you look at inflation expectations in the markets, inflation expectations in the markets have dropped significantly, both in the US and in Europe, meaning that central banks shouldn't worry about creating inflation because at the moment the shock is deflationary. However, there is clearly a very serious supply disruption. And it's very likely that we'll see cost push inflation in the coming month. Certain sectors, certain areas, medicine, China is a subcontractor to a lot of industry in Europe and the US. So what happens in the situation where we see, for example, in 5 or 6 months, rising inflation on the back of a negative supply shock, and central banks start to see that, and you have the likes of Jens Weidmann, Bundesbank, saying, we should be worried about second round effects and rising inflation expectations from this. That would worry me a great deal, of making the kind of mistake the ECB made in 2011 when it hiked rates twice in response to negative supply shock. Therefore, it's extremely important that the present situation, that central banks keep their eye on growth in nominal GDP rather than on actual inflation, because it tells you nothing about the monetary sides of things. So keep an eye on monetary demand, or not on monetary demand, on nominal GDP growth, on nominal demand growth, and indicators of that. At the moment, these indicators clearly tell us that nominal GDP growth is going to slow, both in Europe and in the US. Of course, that's had slowed dramatically in Asia. So today I'm somewhat more optimistic on the world than I was during last week. I'm happy to see central banks getting the message, but I'm also concerned that they are under pressure from some parts of general public opinion. I hear all the same wrong messages as we heard during the summer of 2008. Cutting rates is not good. We're in a bubble. This will just, provide, greedy speculators with another incentive to run, through this bubble. All these kind of idiotic comments, in my view. We need to keep an eye on inflation expectations, and inflation expectations is telling us that there has been a negative demand shock. Central banks need to offset that. If they fail to do that, the demand shock escalates, as was the case in August, September, and October of 2008. And we saw during that period central banks mess up things. So it might be the shock is completely unrelated to monetary policy, but the shock has set in motion monetary matters, and you need to handle things in this matter. This is not about sitting around with a joystick. It's not about discretionary monetary policy. It's simply around central banks doing what they're supposed to do, keeping nominal demand stable to ensuring price stability. In the Eurozone, that is 2% inflation. In the US, that's 2% inflation. But we're going to see, at the moment, we're having inflation expectations, both in Europe and in the US, significantly below 2%. So central banks are not doing enough. I'm not suggesting they should push up inflation above 2%. I'm just suggesting that they should get inflation expectations back to 2%. In what I wrote on Friday, I suggested the Federal Reserve simply came out and said that it will peg market inflation expectation, as we can get them from the TIPS market, between 2 and 2.5%. for all time horizons. If it did that, inflation expectations would immediately jump. The Federal Reserve should not do anything else than just keeping inflation expectations there on all time horizons. Then we would take out the demand shock part of this terrible shock. And then policymakers could focus on dealing with the supply shock in other ways, and mostly importantly, dealing with the medical and social and economic shock in ways that monetary policy cannot. But at least monetary policy should be conducted in such a way that it avoids making things worse. At the moment, because of the operational framework on central banks, it has been making things worse. The action from the Federal Reserve, the Bank of Japan, and Bank of England over the weekend and this morning has moved things a little bit in the right direction. I hope they follow through. I'm very worried that they don't, that they do too little, that they are not focused on stabilizing inflation expectations. I'm worried that they down the road react to negative supply shocks and temporary rise in consumer prices in the wrong way. Said another way, I'm worried about the influence of people like Jens Weidmann. That being said, I do think that Jerome Powell at the head of the Federal Reserve understand that this is a major shock. And I hope we're better equipped to manage this than 2008. But yeah, we will see. We have seen some sun in Copenhagen this morning. So let's hope that central banks also lighten up and do the right thing. And let fingers crossed that this horrendous virus is contained and that the health fallout of this is as small as possible. But again, I have no clue about that, and I will not try to guess how that develops. I just urge central banks to do the right thing.